Main sources of finance available to a business? What are the advantages and disadvantages of different sources of finance? What is the suitability of a particular source of finance for a new and established business? These are the key terms. Read through them carefully. Finance, loan, overdraft, grant, mortgage, credit. Often, the hardest part of starting a business is raising the money to get it going. The entrepreneur might have a great idea and clear idea of how to turn it into a successful business. However, if sufficient finance can't be raised, it is unlikely that the business will get off the ground. Task: pause the video. What are the main sources of funding available to the following businesses, and what are the eligibility requirements? New businesses, growing businesses, established businesses. Raising finance for startup requires careful planning. The entrepreneur needs to decide how much finance is required, when and how long the finance is needed for, what security, if any, can be provided, whether the entrepreneur is prepared to give up some control, ownership of the startup in return for investment. Finance refers to sources of money for a business. Firms need finance to start up a business, for example, pay for premises, new equipment and advertising. Run the business, for example, having enough cash to pay staff wages and suppliers on time. Expand the business, for example, having funds to pay for a new branch in a different city or country. New businesses find it difficult to raise finance because they usually have just a few customers and many competitors. Lenders are put off by the risk that the startup may fail. If that happens, the owners may be unable to repay borrowed money. Some sources of finance are short-term and must be paid back within a year. Other sources of finance are long-term and can be paid back over many years. Internal sources of finance are funds found inside the business. For example, profits can be kept back to finance expansion. Alternatively, the business can sell assets, items it owns, that are no longer really needed to free up cash. External sources of finance are found outside the business, for example, from creditors or banks. Task: pause the video. Research 6 different methods of finance available to a business. You must decide the following. Is the finance internal or external? What size business is it appropriate for? What are the advantages? What are the disadvantages? Sources of external finance to cover the short term include an overdraft facility, where a bank allows a firm to take out more money than it has in its bank account. Trade credits, where suppliers deliver goods now and are willing to wait for a number of days before payment. Factoring, where firms sell their invoices to a factor, such as a bank. They do this for some cash right away, rather than waiting 28 days to be paid the full amount. Long-term sources of external finance. Sources of external finance to cover the long term include owners who invest money in the business. For sole traders and partners, this can be their savings. For companies, the funding invested by shareholders is called share capital. Loans from a bank or from family and friends. Debentures are loans made to a company. A mortgage, which is a special type of loan for buying property, where monthly payments are spread over a number of years. Hire purchase or leasing, where monthly payments are made for use of equipment such as a car. Leased equipment is rented and not owned by the firm. Hired equipment is owned by the firm after the final payment. Grants from charities or the government to help businesses get started, especially in areas of high unemployment. Task: pause the video, complete the following exam question below.